A complex correction explained. A complex correction explained. This tutorial is about Elliott wave theory, and we want to discuss complex Elliott waves corrections. All right. We are looking at Intel stock, and we can see clearly that the stock was bullish from 1992 up to the year 2000. All right. So for 8 years, the stock was going up. We have different phases during this trending phase. This is the normal trending phase when the price was going in a diagonal move, because the normal progression of the price is what we call a diagonal move. This is the red line. You can see that the price was going almost a diagonal. This is the normal progression. But from mid 1999, we can see that the stock starts, a distortion here, which is a vertical, price move. All right. So I'm going to color that into pink, or I will use a different color that into turquoise. All right. So here it is, start going almost vertical. But we know that a vertical price action is a distortion. How do we know? Well, because we have only 3 market patterns, and they are a rising channel, all right, a declining channel, and a horizontal channel, all right. We do not have a vertical channel. Therefore, any price action that is a vertical is a distortion to a certain degree. Now, you have to understand that when we are using the word distortion, doesn't mean that there is a market manipulation, but it's just a distortion when the asset is overbought, and overbought 3 times overbought, and no one cares, and they just keep buying. It's not a market manipulation, it's a distortion that has been prolonged over time. Is distortion in relation to the price, and distortion in relation to the time, which is the most dangerous distortion. Okay, I don't want to dwell on that. So we have a normal progression, and then the price went up almost vertical. But this is, the trending phase, from here, beginning of 1992, all the way to, mid 2000, this is the trending phase. But because you can see that we say to you, normally we have the Elliott wave cycle, the trending phase. So what we usually draw to traders is that the trending phase, we never put it like this vertical. It's a trending phase followed by a correction will form the Elliott wave cycle. All right. But here we have a trending phase that is distorted. Now you can forecast with certainty that with this kind of vertical price move, there is a high chance that the correction that will follow the trending phase is likely to be a sharp correction. So that was exactly what has happened. A distortion that was followed by a sharp correction. Why did we have a sharp correction? Because we have both the distortion of the price and big distortion of the time. I don't want to get into that subject now, but what we can say to traders, an Elliott wave cycle was underway. This is the trending phase from here all the way up here. And a correction that has begun was a sharp correction because of the distortion here. So followed by a sharp correction. You see how the price went down? Sharp to cancel this vertical move. So the sharp correction cancel the distortion, followed by a normal progression. So here, I can show you that the correction was like this. Sharp move down, vertical, followed by what? A normal correction. A normal move down. But what I want you to understand here, talking about, complex correction explained, we want to spend a bit of time paying attention to the correction here. So now we know the trending phase, which is up to this vertical line, but between the 2 vertical lines here, this is the corrective phase. And we want to talk about complex corrections, okay? So let's look a little bit deeper into this correction here. It is a complex correction after this trending phase. One can expect that the first part of the correction here will be a sharp correction because of the distortion that has taken place here. Here it is, cancel the distortion up to this point. Yeah, I want to draw a little bit of a line there because I have a reason for it. I will explain it to you later. This line here, this horizontal line. Here, pay attention to it, this line here. The intersection between the normal progression and the vertical progression, we draw, okay, an horizontal line to that point. Because if the correction is sharp, it will bring the price straight down to that horizontal line. Boom, down, which it did. But then the price, you can see, it went up a bit, pulled back, went up, blah, blah, blah. But let's consider this move right from here all the way here as a sharp correction because it's part of the sharp correction. So this move, will you agree? From here all the way down, let's consider as a sharp correction because 70% of this move is a sharp correction. Let's call this move from here all the way down as a sharp correction. So we can say that after the trending phase for Intel stock, somewhere in mid-2000, a sharp correction has begun and has ended somewhere in 2000, at the beginning. This is the beginning of 2003, okay? At the beginning of 2003. All right? So that's the end of the sharp correction, okay? If you agree, okay? So that's the first phase of the correction. One thing I need to clarify with traders, Elliott with traders right now, is that when you see a sharp corrections, all right, what usually take place, the common Elliott wave trading mistakes that even some experienced traders are making, all right, is this. So generally, when we have a trending phase, we use the Fibonacci retracement level to highlight the full length of the trending phase, and then usually we highlight the 50%, all right, and the 61.8% Fibonacci retracement level of that trending phase. So as the sharp correction came down to that zone, sometimes market participant will make a mistake. We place order here to buy straight away. They like to buy straight away here. It's crazy. In fact, it's crazy. All right. If you are a client, okay, and somebody buy for you a stock after a sharp correction to this zone like this, you should ask for a refund. Now, this is to make you laugh a bit. I don't want anybody chasing me on the street for saying this. I'm not going to dwell on it. But in fact, it's a big mistake. Okay, a gigantic trading error. Because the sharp correction never stops straight away like this. You see that it comes down full down, that's to correct the distortion, and then you will see a bit of bounce up, which is this one here, this section here. So whenever you see a correction sharp like this, you see then it start going normal a bit, then you see a bit of bounce like this, okay? It's not finished yet, all right? And then it will come down like this, unless, repeat, unless the sharp correction cancel the previous trend. What do I mean by that? So the sharp correction that starts here goes down all the way to the beginning of the trend. In that case, it's finished. So we will, what you need to do, if you see that, what you need to do, go away, all right? Go away. It's not going to trend straight away, all right? It's not going to trend straight away. It will consolidate. Because why it will consolidate? Remember this. I want you to remember this. Remember this, powerful. When we have high volatility, after a high volatility, we have a low volatility. When we have a low volatility for a long time, then we have a high volatility. So the sharp correction is a highest volatility in the financial market. So when it comes down like this, I'm talking about when it cancels it totally, wait for the dust to settle, go away. You can go away from that stock, go away from it for a while. You can see here after the sharp correction, look, all this year, from, let's say, from 2002 up to 2009, not much has happened. Consolidation, consolidation, consolidation. You see now, I want you to understand this so you don't forget it. The characteristic or the aftermath of a sharp correction is a low volatility, usually consolidation. So here we are. So a sharp correction has taken place, okay, from 2001 to 2003, okay? Here it is, finished. That sharp correction has ended. The next part of this complex correction that I'm trying to explain to you is that there is something else that we call X. So you may see sometime trader will talk about a zigzag 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. So A, B, C, all right, zigzag. And then they will say X. And then another zigzag 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5. So zigzag, X, zigzag, all right? So it's a complex correction, all right? Looking at Intel stock on the monthly chart, we have a sharp correction that has ended in 2003. In fact, it's in 3 moves all the way down, bounce up, which is normal, and then a bit boom back down. A sharp correction has ended here. You see this move here, this move that I highlight in red, that's what we call X. What is X? X wave. So you will say complex correction. So today we say zigzag X, zigzag X, zigzag X. All right? So the X wave, my friend, let me clarify that with you, is a trend that has failed. You can quote me on that because I am the first person explaining it, okay, this way. The X wave is a trend failure. Why? Good question. The reason is we have a trending phase, and here we know that this correction has finished, okay? So at this point in time, investors say, okay, the dust has settled, okay, Intel, okay, it's now oversold, people should buy, okay? And then people start becoming a little bit bullish. So people are not bearish forever. So you can see the market was bullish almost 10 years, and the correction was only 3 years, very fast, okay? So it's not bearish for too long. Now the market wants to start a new trend. But that trend, as it began, is not supported by a bullish market environment. It's not supported by strong fundamental. Therefore, the trend will fail. That's what we call X. This is X here, the trend X. So you see here, it came down 1, 2, 3, sharp correction, X. The X is the failure of a new trend that is beginning, but that is not supported by if it's a bullish trend, it should be supported by a bullish market environment, strong fundamental. If it's a bearish trend, we want to see a bearish market environment and deteriorating all right, financials, but here we are, it has failed. So you may say, if you were here, you'll be thinking of fast wave, all right? But how do we know it's X? Now, if you have X, you're likely to see another correction. Generally, what has happened before the X is likely to happen again. It's the theory. The reality of the market can be different. But remember that generally, when we have a zigzag before the X, after the X, we are likely to have similar pattern. That is the theory. All right? But know that and be aware of it. So now we see the X here. This is the X wave of the complex correction. Now we have again 1, 2, 3 zigzag, a correction. So the correction that we thought has ended in 2003, and people were willing to buy, that the X is the failure of the trend, followed by the same correction here, 1, 2, 3. After 1, 2, 3, which are counted here, you see, this will help you if you understand the complex correction that I'm explaining to you. You are likely to forecast the market. All right? So you will see it soon. So now we have again 1, 2, 3. So we are here. So here we will be thinking again that, okay, we have a double bottom pattern with a higher low after 1, 2, 3. Minimum price move is free, yes or no? So using the first free Elliott wave trading system, we draw our warning line here. Yes or no, my friend? We will. So we say minimum price move is free. We apply a top-down trading method here for swing trading, day trading purposes, and here it is, it's going up. If the fundamentals are not solid, all right, the market environment is not suitable. Remember 2007, 2008, all right, we have what? The financial crisis. The global market has peaked, and Intel was trying to trend when the global market is becoming weak, and that trend has failed. So once again, we have again another X here. The theory stated that we can have, okay, 3 times the same correction, which means you see zigzag X, zigzag X. All right, so this is it, zigzag X, zigzag X, and we are likely to have another zigzag again. 1, 2, 3. And then we'll say that maximum is free. All right? That's the theory, my friend. That's the theory. They say maximum is free. So you have 3 times the same correction. 1, 2, 3, X. 1, 2, 3. Second time, X. Now the third time, 1, 2, 3. That's it. They will say finished. The correction has ended. So this is a complex correction that has taken place here for Intel stock, a trending phase from 1992 up to mid-2000, followed by a sharp correction from mid-2000 to 2003, followed by the wave X, and then a zigzag X, and another zigzag. Here the market will call this level a bottom for Intel stock. Intel stock is now beginning to start a new bullish trend, so to speak. Where are we now again? The stock market has peaked. We are in 2016 today, and Intel is trying to trend again. When will Intel be free to trend? That is the question. All right. So here again, we will expect that a new trend will begin. So you can see here we didn't have all the X and the zigzag. The price starts. So after 3 times, 1, 2, 3. Okay, here 1, 2, 3, and then 1, 2, 3. They say that's it. That's enough. That's enough. Correction finished. That's the theory, my friend. Remember, whenever we are speaking, we say that is the theory. It means that sometimes things can be completely different from the theory. Now, you may think that I say this just for fun, but I have a reason why I say it, because some traders, that's the way they think, all right? 1 + 1 = 2. But when you are trading, you have that mindset, you find it difficult to trade. In the financial market, it's not 1 + 1 always equal 2. Okay, that's what we are trying to do. So when you are using a wave theory, do not use it as a science. So don't be surprised when I'm saying that's the theory, that's the theory. You may find it I'm repeating myself, but there is a reason for it. Okay, so forgive me for that. Okay, so what can we learn from this complex Elliott wave? All right, so whenever we see, okay, a correction followed by X, there is a high chance that the previous correction is likely to happen again. So after this X, a failure of this trending phase is kaput, we know that we are likely to see another 1, 2, 3. Here it is. With that information, we are ahead of the market. We can forecast what is likely to happen to Intel stock in the next few years. That has a high chance to go down, to go up, and to go down again. And then people will try to buy again, forming the new X. And then at the end of the X, we can forecast again that this stock has a high chance to go down, to go up, and to go down again. And from that point onward, people will be more willing to buy because the same type of correction has happened 3 times. 2X, that's enough. 3 correction, that's enough. The X is the failure of the trending phase after a correction. This is what we are saying to traders when we are talking about trending phase or any impulsive wave. Now, sometimes, especially swing traders, so you learn Elliott wave, you can't wave, and you count it, okay? Now you're expecting your third area wave, all right? So you are expecting your third area wave. You count it is correct, okay? You are expecting your third area wave. But for that third area wave to begin, we need to be in a bullish market environment, yes or no? So you want to sow something. Do you sow any season? All right? You don't sow any day, any month. All right? Check the market environment first. Okay. So you want to buy and hold because you have pinpointed the end of the second wave. Okay. I'm ready to buy the third wave. Check the market environment and then go to Google Finance, perform at least Google Acid test. Financials, okay? All right? And then check the sector, all right? If everything aligns very well, but one thing that you don't want to forget, the competition. So suppose they have an excellent balance sheet, but they are now under a strong competition and they are not coping very well. Will you buy and hold? Does that company have a long future, or do they need to reinvent themselves? Reinvent themselves, or create new products, become more innovative, all right, to gain more market share, be a little bit more practical. So the reason why I'm saying this is that sometimes traders are too technical and they use the wave theory, and nothing happen. They are expecting the third area wave, and the third area wave never show up. So by checking the fundamentals and the market environment, being a little bit clever, are they coping with the competition? Are they gaining more market share? Those questions will help you know, okay, whether the third area wave will take place or not. Talking about a complex correction explained, here we are, we have a sharp correction, okay, in the form of a zigzag, followed by X, which is the failure of a trending first. We will expect the same zigzag pattern to follow the X wave. Here you see 1, 2, 3. We will expect again another X waves, which means a failure if the fundamental. So the reason why we have the second X is because it doesn't mean that we'll definitely have a second X. It means that at this point in time, in 2006 going to 2007, the market environment was not good for Intel, and what was going on here, and it couldn't finish the trend. That's why we have X here. Well, after that, another correction. Here, since 2009, Intel is finding it very difficult to come out of this range between the level of 38.52 and the level of 1727. Is still in consolidation. Remember what I said to you before, when we have a sharp correction, you can go away and wait and stay around. If you want to play Intel, all right, now I'm not going to give any advice here. I will leave that subject to myself. But the point we are saying here is a complex correction, a sharp correction, X, zigzag, X, zigzag. Very often, traders think that a correction should be very simple. So price goes down, 1, 2, 3. People say, that's the end of it, and it will be bullish. And price goes up to a certain point. It's time to cash out. People don't pay attention to the resistance. They stay in the trade. They say, all right, this stock will go up because the correction has finished. People are just fooling themselves. And here it is, another 1, 2, 3, giving you a warning. And you say, here it is, start going up. It's going to go up. I will not going to sell now. And here it is, 1, 2, 3, and then you lose your money. You don't want to do that. With this information, you are able to forecast what is likely to take place using the complex area wave to be ahead of the market and also to make excellent trading and investment decisions. Before I close this video, I'd like to remove my lines on my chart. And there is one more thing I want to add to this video so you may start trading the sharp corrections, okay, and the complex correction like a pro. All right, so hold on a second. I want to remove, 2 more lines, and I will share one more tip with you. It's about my own proprietary trading tool, a diagonal move. As you can see here, a normal progression for Intel followed by a vertical move. You can forecast where the sharp correction is likely to end. We use something that we call the opposite diagonal. Go to www.stochastic-market.com, click on proprietary trading, and you will see videos about the diagonal move, vertical move, return to the opposite diagonal. So what we are talking about is this: price goes up in normal move, which is a diagonal move, and then it start going in vertical move, which is a distortion. we draw this kind of a rectangle. So you see the rectangle, the red part, okay, the vertical move, and then we just draw it like this as a rectangle. And then we draw the normal diagonal for this rectangle, okay, here, all right? Okay, so we have the normal diagonal, and then we draw a line that is directly opposite to the normal diagonal. See the normal diagonal, that's the orange line here. You draw a line that is directly opposite to it, which is the pink line here. So as the price going up, we see it start coming down like this. We quickly draw our lines like this, and we know that that correction can come down all the way to the edge of the pink line. Isn't it great to know that? All right, to know where the price is likely to go. And here it is. Pay attention to the pink line, the opposite diagonal. As it starts crashing down, it touch it here first down. You see here? Pink line, the opposite diagonal. Diagonal move, vertical move, return to the opposite diagonal. Touch it here. Bounce up, touch it again here on the edge. By combining, okay, this proprietary trading tool and a sharp correction, one can make excellent decisions. Some stocks that are very, very bullish will not touch the opposite diagonal, but will stop at the intersection between the diagonal move and the vertical move. That's why I draw the the horizontal line. So the intersection point between the normal price progression and the vertical move is a point. So we draw just horizontal line through that point, which is the blue line here. Are you with me? Let me extend it and color it. I'm running out of option now. Color in turquoise. Just draw horizontal line to that intersection point. And if the stock is very, very bullish, it will not touch the opposite diagonal, but instead will find a support on this horizontal line. All right? So you can see the sharp correction brought the price to the horizontal line first, but before it bounced, it went up a bit before coming down to retest, okay, the pink line. So be aware of this horizontal line and the pink line. Okay, it makes sense? This is the end of this tutorial about a complex correction explained. A correction can be very simple in the form of a zigzag, a flat correction that trader can quickly recognize. But when we are dealing with a correction, we need to always, okay, be ready to accept that a normal correction can be a complex correction, because at the time when we are expecting that the correction has ended, that a trend is about to begin, all right? If the fundamentals are not solid or the market environment is not suitable, that trend will fail, all right? That's what we call X, all right? And then that the same correction will take place again, and then we will expect a new trend to begin, and if conditions are not suitable again, that trend will fail, and we'll label it again with X again, and we'll expect the same correction to take place. The X wave is the failure of the trending phase after the first leg of a complex correction. All right? If you have any question, put in the comment section. If you have any suggestion, put in the comment section. I read all the comments and I record video accordingly to what traders are saying, what they are asking, so we can learn more from each other. All right? Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about complex correction explained. Until the next time, enjoy yourself and be very happy. Speak to you soon.